It's very important for investors to have an adequate understanding of the economy, how the economy is performing, because eventually the state of the economy will certainly affect the nature of returns one would derive from the stock market. So in this video, I want to highlight characteristics of economic recessions. What every investor should know. Economic recessions are a period of significant economic decline, typically characterized by a reduction in economic activities across the entire economy. And so here are the key characteristics of um, of an economy that is facing recession. Number one is decline in gross domestic product. There will be a general decline in GDP. That is it is characterized by a contracting economy. Recessions are marked by a decline in GDP for two consecutive quarters or more, indicating a shrinking economy. Whenever the GDP declines by two consecutive quarters or more, that economy is facing a recession. Not only that, there's reduced production. There's a reduction in level of production. A downturn in economy, an economic output, including manufacturing and services, reflects, lower demand for goods and services. In an economic downturn, there's that decline in overall production in the economy. When it comes to the production of goods and services. Number two is rising unemployment rates. There's that spike in unemployment rate as a result of job losses. Recession often leads to significant job losses. As companies cut back, they stop hiring, they lay off, staffs as a result of cut down in production because of reduced demands. You equally have higher unemployment. The unemployment rate typically spikes sharply, it rises sharply, and it can take a long time to recover. Even after the economy improves, it takes a long time for employment rates to recover. Number three is decreased consumer spending because of lower consumer confidence. Consumers tend to spend less. They spend less during economic recessions, due to uncertainty about their financial situation and the broader economy. When you're not certain about what the economy will look like, in the near future, you tend to conserve money. You don't want to be spending anyhow. There's a general cut down in expenditure by consumers. And that's a typical indicator of a poor economy. There's also that shift to essentials. Spending patterns may shift with consumers focusing on essential goods and services, while cutting back on discretionary items and items that be considered as luxuries. You tend to cut down on all those things. Number four is business contraction and closure because of reduced revenue. Businesses experience declining sales and revenue, leading to cost-cutting measures, reduced investments, and sometimes even outright closures of factories or industries. We equally have bankruptcies. You discover companies will be declaring bankruptcy at an alarming rate, particularly among smaller firms and those in vulnerable industries. You record a large rate of, companies shutting down, closures, and retrenchments, all typical characteristics of an economy in decline. Number five is decline in investment. Decline in investment. There's that reduction in capital expenditure. Companies will cut down on capital expenditure. They will cut down on research and development. These are all examples of um, of an economy facing recession. They will buy less equipment. Wouldn't want to embark on new projects, you know, which would eventually lead to lower capital expenditure. And we equally have cautious investors. Investors become very cautious. They become risk averse, leading to reduced investment in stocks. You know, and so startups may not even have investors coming in to invest in them. And that is the nature of economy in recession. Everybody's so cautious. They reduce expenditure. People don't want to spend money. Even companies don't want to. They tend to conserve cash. Number six is falling stock markets. There's that decline in asset prices. As we all know, the economy influences the stock market, and the stock market influences the economy. They tend to they work kind of hand in hand. And so there's that decline in asset prices. Stock markets often experience significant decline during recessions as investors react to lower corporate profits. Generally, in times of recession, consumer spending is low, revenue is low, and decline in revenue certainly affects the bottom line. And so with decline in profits, discover that the earning per share of companies will decline. And with a decline in earning per shares, that decline in stock prices, it will certainly affect asset prices in the market. With declining stock prices come declining, declining profit will lead to declining stock prices, which eventually will result in a bear market. So extended recession can lead to bear markets, where stock prices can fall by as much as 20 to even 30%, from their recent highs. Number seven is tightened credit conditions. Discover that banks would reduce lending. They would cut down on lending. Banks and financial institutions may tighten, lending standards, making it harder for individuals or businesses to secure financing. They can not very easily secure, credits. And there's also heightened interest rates and higher interest rates. In some cases, interest rates on loan may increase as lenders become more cautious. The central banks often lower rates to stimulate the economy, but when it comes to individual lenders, they tend to heighten their interest rates, because of the nature of the economy, because they may envisage, distress among borrowers. Number eight is discretionary or inflationary pressure. You come across deflation. In this case, in some recessions, prices of goods and services may fall due to reduced demand, leading to deflation, which can further weaken economic activities. In this case, you have fall in price of items, of goods and services, and that will lead to more economic woes. You equally have inflation. Alternatively, some recessions, especially those driven by supply shocks, may experience inflation, where price rise despite a contraction in the economy. This irony can happen. In a declining economy, you tend to experience inflation in certain categories of goods and services. It's a possibility. Number nine is increase government intervention. There's that fiscal stimulus. You have Q1, Q2, etc., in advanced economies. So the government may come in to kind of implement fiscal policies that will stimulate the economy, you know, and increase public spendings, such as cuts in taxation, and or direct payment to individuals in order to be able to boost the economy. Like what happened during the COVID-19, government, handed out, funds, cash to individuals so as to be able to jumpstart the economy. That was evidently in recession. So you equally have monetary policies where central banks may lower interest rates to engage in quantitative easing or take other measures to support financial markets and encourage borrowing. They may support commercial banks to increase borrowing. The more people borrow, the more people spend, and the more people spend, the more the economy will the more the chance of the economy, uh, undertaking a kind of recovery. Number 10 is lower consumer and business confidence. You discover that there's that decline in consumer sentiments. Confidence among consumers and business typically decline during a recession, leading to reduced spending, investing, and even hiring. Everything is just at a low key. You equally have uncertainty. Uncertainty about the future economic outlook can exacerbate the effects of recession, leading to a prolonged period of economic downturn or economic weakness. The general, uncertainty in the environment, tend to like accentuate or perpetuate, its economic woes. So, generally, as an investor, you should know, the impact of a recession in stock markets. That will help you to be able to navigate, recessions and know how to develop a strategy that will help you still obtain and a decent return in a recession.